How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Right there is my website, and to kind of put a name to the face, this is me right over here. Um, Today's topic, I want to discuss with you guys guaranteed universal life insurance, guaranteed UL, and kind of why I prefer this for death benefit only policies. I prefer this type of insurance over whole life for majority of my clients. First, I want you guys to understand that this is a permanent death benefit. It's not like other typical universal life policies that you've maybe heard a lot of really bad things about. This word guaranteed plays a very large part, and I want you to kind of think of this policy first and foremost as a permanent term policy, because with these types of policies, you're not necessarily you don't really care too much about the actual cash value that grows inside of it, because you're only trying to maximize your actual death benefit for tax-free for a tax-free inheritance to your loved ones. One thing to understand, and you have to make sure that you're doing this correctly, it's very, very important that you do not make the mistake of purchasing a guaranteed universal life policy without the contract death benefit lasting forever. So that's one of the first things that, if you're taking down any notes, you want this death benefit to last forever until the day that you pass away. You want to make sure that those proceeds are then paid to your, to your beneficiaries. So first I want to kind of conceptualize how a universal life insurance policy works, and then why they quote unquote blew up, and to kind of show you why these guaranteed ULs came out and they're pretty attractive. And kind of why I recommend the guaranteed UL over the other types of death benefit or permanent death benefit policies out there if you're looking to minimize your costs but still create that death benefit maximization. Let me just open up a new screen real quick, and I apologize for my very sloppy handwriting. I just want to try to take down some notes and try to help you guys out best I can. So that's why I have my little digital notepad up and right over here. Universal life insurance, also known as UL, was supposed to be a permanent death benefit life insurance policy with favorable taxation benefits. Okay, this was supposed to be the next best thing, and they came out in the 1980s. And essentially how any sort of permanent life insurance policy works is you have your premium dollars. They go into a life insurance policy. Now, this life insurance policy is separated into two separate segments. You have a cost of insurance and you have a cash value. And I have other videos out there, so this is going to be a little bit repetitive, but I just want you guys to really understand this. Now, the cost of insurance inside of any permanent death benefit policy is permanent life insurance policy is going to have something in there known as an increasing annual renewable term. And this is going to make a lot of sense later on. So if you purchase one of these plans, a typical permanent life insurance, or just say we'll use the example of a regular universal life, if you purchase this at age 30, you will have a cost of insurance, which are like fees, agent commissions, expenses, different things like that. You would have a 1-year annual renewable term. It's called ART. That's actually inside this policy. So it gets you at the earlier years, obviously at age 30, you have a cheaper annual renewable term policy, meaning that you're covered for 1 year within this life insurance policy. And let's say an example, it might cost you $100 per year. But you are putting, when you first take out a universal life insurance policy, you are placing, let's say, $1,200 into this plan. Why would you be placing that much more in there? Because your cost of insurance cost $100 for that year, and you place $1,100 more into this plan, that additional money is going into something known as cash value. Okay? Cash value, I want you guys to kind of think of it as a savings account. And the universal life came out because their cash value interest rate that they gain, just like how you'd gain in a savings account, is tied to interest rates. I mentioned that this was first created in the 1980s. So this is when interest rates were in double-digit figures. So in a perfect world, you'll be placing $1,200 in there. $100 going towards the cost of insurance for that given year, and $1,100 is going to go into cash value that should have some favorable growth with it. With this case, with the universal life policy, that growth was tied to interest rates. And this is based in a perfect world. Now, there's other, fees that are involved, or at least intricate details within the cost of insurance. But I just want this to be extremely basic so that it doesn't over confuse you. So what you're doing is you are overfunding the life insurance policy in the earlier years because you took this out when you were age 30. Every year you live, age 31, 32, 33, it makes the 1-year term larger because your chance of death is 1 year greater. Now, a lot of advisors don't even know that. With the cost of insurance, it's tied to the different fees associated with the insurance company and the annual renewable term that increases every single year. So that's why when you're age 70 and you take out a life insurance policy, you pay a heck of a lot more for life insurance than a people. It's because, and this is a permanent policy, is a term policy, because your chance of passing away is increased that much greater. And I hope that makes a lot of sense. It is because on mortality rates, and I'll write this down so you guys could even, mortality rates. It is a larger risk for the company to have a 70-year-old on their books than a 30-year-old. And I really hope that's very clear to you. I mean, it's pretty obvious, but the thing is that's why they try to compute and make sure that you're paying more while you're younger to overfund these policies so that when the cost of insurance becomes greater, you're not going to have a problem, and it was because you overfunded it for all those years plus the interest to actually give you to make sure that it sustains the cost of insurance in there. So if you're still paying our hypothetical situation of $1,200 per year, but now your COI is $3,000 per year. This is just another hypothetical. How does a policy remain in force? Now remember, you were overfunding this in the earlier years. So at age 30, when the cost of insurance was only $100, you were placing $1,200 into the policy. But now at age 70, your cost of insurance is $3,000, but you're only placing $1,200 into the policy. So your cash value, essentially, it needs to sustain the life insurance, the cost of insurance in there in order for you to keep your policy. Now, this is the mistake that companies made, is because they were looking at such a short-term window and they weren't looking into the future. What they wanted to do was, with the universal life insurance policy, they have their cash value tied to interest rates. So they were expecting interest rates to always remain the same in double-digit figures. And essentially, in the early 80s, when these policies came out, it was as if interest rates were never going to change. And that's where the flaw took place, because the calculations of expecting 12, 14% rates of return made people and companies have their clients minimally fund these policies. And I hope that makes sense. I'll repeat kind of what I said. This flawed the calculations regarding life insurance when the ULs first came out, because everybody was expecting 14%, 12 to 14% returns on their money, and they were minimally funding their life insurance policies. Meaning, okay, at age 30, if we understand that you're overfunding the policy, let's say that you never gain an interest rate. You never had any sort of interest that actually gained within that cash value. At age 30, your cost of insurance is $100. So you put $1,100. The next year, maybe your insurance is $120. Your actual annual renewable term, your cost of insurance. So then you overfunded it, $1,080. So all that money is now stacking up within the cash value, so that when you're actually becoming older and your prices of your cost of insurance is increasing higher, actually placing in there, you're going to have some substantial cash value to kind of borrow from to make sure that that policy stays in force. And there's a lot of there's a lot of details there, but I really hope that that makes sense, because if their expectations were that interest rates, that the amount of money in the cash value is going to be so much larger, then they'll say, okay, well, you know what, we're going to give you a permanent death benefit policy. We're going to expect the cash value to not only be overfunded, but also have significant rates of return on that cash value. In those later years, you're going to have more than enough cash value to sustain that policy. What do we know happened from the 1980s to present day? Interest rates went down and down and down. So everything was flawed regarding their calculations, meaning that they minimally funded the policies, and now they could not sustain those policies anymore. So what exactly happens when you minimally fund the cost of insurance, the cash value, and the interest rates are not as high as you expected them to be? These policies, you might hear this is an industry term, but it's called quote unquote blow up. And that all that means is that there's not enough money to fund the death benefit. Life insurance policies are supposed to be meant for life insurance. It's supposed to be meant to make sure that your death benefit is there. So I know exactly what you're thinking. Well, if I own one of these policies and I just assume that, everything was good, what exactly happens when this policy blows up and there's not enough cash value there to sustain the increase in cost of insurance? Well, the company will first send you a letter, or they might give you a phone call if they're nice to let you know that your policy has increased in price. And on top of it, you need to pay the difference immediately. Now, you could have been paying $1,200 a year for a policy, and then they let you know that you need to pay $10,000 immediately to keep the policy in force. That's not even the worst part. The worst part is this $10,000 is only good to keep the policy in force for 1 year. Because as I mentioned before, you have annual renewable term within that policy. So your cost of insurance is going to increase every year. And this does happen. Please understand, I'm not just trying to scare you. This happens a lot. It's happened to my actual parents in 2008. I went over, I analyzed all their policies because they took out universal life policies in the 80s, and these policies were subject to blow up in later years. So this is why I want to recommend to you guys something known as guaranteed universal life insurance. And why it's, first off, much safer than a universal life policy, but why I prefer this over whole life insurance and this is a big if you're not looking for cash value growth potential in your policy and you just want to have, death benefits. So I want you to think about it as kind of like a permanent term. So to kind of review, we have your life insurance policy. Your premium dollars go in towards life insurance, and it goes into a cost of insurance, and the remaining amount goes to the cash value, which is linked in a universal life to interest rates. So you pay a flat premium every year, hoping that this policy will stay in force when you pass away. That's why there's risk associated with ULs. There's risk associated with ULs, VULs. There's some with IULs, but it's a little bit better. I have another video out there on the actual IUL, and I actually really do like the IUL, but I just kind of want to stay on the same on the track with kind of the universal life. The universal life, just a straight universal life policy, does not have a guarantee. There's no guarantee because you need to make sure that your premium dollars and the cash value will sustain that cost of insurance. Now with something known as a GUL, which is a guaranteed universal life, guaranteed being a very large word, there is something attached to this policy known as a rider. So the rider kicks in if the cash value hits 0. So with this type of insurance, you are paying a premium into the life insurance policy, and what happens is that you have a little bit extra premium than a universal life, but you have that peace of mind factor that the death benefit will always be there. So you have the guaranteed rider over here as well. Now what happens is the life insurance goes into the cost of insurance and the cash value. Yes, you will have some cash value growth within this policy, but what they try to do with these companies have been very good with, and the ones that I represent or at least have dissected in recent years, they try to minimize the amount of premium dollars to make sure that when your cash value does hit 0, and they try to really project that it will hit 0, this guaranteed rider kicks in so that your death benefit remains in force. Premium dollars go in to the cost of insurance and the cash value. The cost of insurance is still increasing every year, meaning that the cash value will become less and less and less. Once this cash value hits 0, the guaranteed rider kicks in, allowing tax-free death benefit to your beneficiaries. It's a guaranteed universal life policy. I want you to think of this kind of as and I keep stressing this, a guaranteed permanent term policy. You are buying this type of policy solely for the death benefit purpose. Just like how life insurance is supposed to be purchased. Purchase is for the death benefit. Now, majority of times, the GUL policies are the cheapest form of permanent death benefit policies, and majority of the advisors don't even know how they even work because this is fairly new. It's not fairly new. It's just that a lot of advisors are captive agents, and if their agency does not sell a GUL policy, how are they ever going to know about exactly how those things work? So with our company, we represent over 200 different companies and we make sure that you have the cheapest possible maximum death benefit policies if that your goals is to so that you have that permanent death benefit and you do not have any you do not care at all about the actual cash value. Now, I make tons of these videos for free to educate the average individual out there and allow them to fully comprehend the different types of financial language out there. Every single financial product, life insurance policy, it's a different tool in a tool belt, and it only correlates to your specific situation. And you have to understand which actual contracts can. Just like how I always use the analogy, you never want to, you never want to hammer in a nail with the end of a screwdriver. You want to use a hammer. A same type of thing. Each tool serves their own purpose. Going forward, I want you guys to make me a commitment. Because of all these free videos and free education that my company always provides, I want you guys to make sure that you leverage my company as a resource. The name of my website is retiresharp.com, and what I want you guys to do is to just give us a call. We have 24/7 customer service, and if you own any type of life insurance policy or you're interested in purchasing any type of life insurance policy, give us a call because you need to become educated first and foremost. You do not want to be wasting away thousands and thousands of dollars if either you want to, pull your cash value, you want to set up a permanent life insurance policy, a term life insurance policy, however this is. And if you're not educated, then you're going to be vulnerable to any sort of type of loss. Now, I stress to you guys, my parents actually fell victim to this universal life insurance trap in 2008. That's when we actually caught we basically caught the flaw in their life insurance coverage. And I have physically saved hundreds of clients from common life insurance mistakes. I make sure that all my training for all my licensed advisors, that they understand exactly how all this stuff works. If you need help making sure that your current policies are protected, or you need to obtain life insurance, please give our 1-800 number a call. It is, I have a link designed right below this on YouTube. It's 1-800-566-1002. Once again, we offer 200 different of the top rated life insurance carriers in your state, and we want to make sure you're getting the correct, and I stress correct, coverage at the cheapest possible price. I really hope that this video has helped educate you on universal life insurance and guaranteed universal life insurance, and why I prefer that over any other types of death benefit policies, or at least permanent death benefit policies, if you're only looking to maximize your death benefit at a minimal cost, and you're not necessarily worried about, or you necessarily care about cash value. The guaranteed universal life is definitely the way to go, but you have to make sure that you're dealing with somebody that knows exactly what they're doing with this. Please be on the lookout for some of my other videos. I hope that this has helped you out. Once again, my name is Derek Afasi. I'm this good-looking guy right over there, and I just want to say, thank you very much, and please leave any comments or feedback, and I'll try to help you guys out best I can. Thank you.